Hello and welcome back to Global Value. In today's video, we're performing a fundamental stock analysis of Oracle Corporation, ticker symbol ORCL. So we're looking at Oracle today as a subscriber request. Right now, Oracle is trading for $81.05 per share. We're recording this video while the market is open, so their stock price is likely to bounce around just a little bit during our analysis. Right now, over the past year, Oracle is down 16.5%. Over the last 5 years, it's a completely different story. Oracle is compounding at a rate of 11% annually. Over 10 years, Oracle is compounding at a rate of 9% annually. And going back prior to the global financial crisis, over the last nearly 18 years, Oracle is compounding at a rate of 10.5% annually. Keep in mind that they also pay out dividends. So right now, Oracle has a 1.6% dividend yield, which is right about in line with that of the yield of an S&P 500 ETF. And so their average dividend yield throughout this time frame would be in additional to this compounded annual return. Oracle right now is trading in between their 52-week high and their 52-week low. Oracle is a very large business. They have a $217 billion market cap, and they have little to no short interest around their business right now. So for more background about the company, Oracle provides database technology and enterprise resource planning, or ERP, software to enterprises around the world. Founded in 1977, Oracle pioneered the first commercial SQL-based relational database management system. Today, Oracle has 430,000 customers in over 175 countries, and it's supported by a base of more than 136,000 employees. The company markets and sells its cloud, license, hardware, support, and service offerings directly to businesses in various industries, government agencies, and educational institutions, as well as through indirect channels. Oracle Corporation was founded in 1977 and is headquartered in Austin, Texas. One interesting thing about Oracle as a business is that they created the software language Java. So for our fundamental analysis today, we are performing the Select 6 analysis, taking a checklist-style approach of 6 standard financial metrics to come to a holistic and beginning understanding of Oracle based off their business fundamentals. So this analysis is still a work in progress, and it's an opportunity to learn in public, so it will continue to evolve and improve and get better over time. With that said, let's get right into today's analysis. Starting things off with metric number 1, we want their average return on capital over the last 5 years to be above 14%. And there are 2 major reasons for this. The first is that over the long run, over the course of decades, a stock is likely to return approximately what its underlying business returns, and these business returns are going to be captured here by return on capital. And the second is that the average publicly listed business earns about a 7% return on capital. So by asking for a benchmark of 14% or higher, we can potentially build in some margin of safety for ourselves based off the overall quality of the business being about twice as good as average. Oracle has increased their returns on capital over this period. They earned just under 20% returns on capital in their fiscal 2022, and over their last 12 months, they're earning about 15.5% returns on capital, so this is down slightly from where they've been at. However, averaged out over these previous 5 fiscal years, Oracle's earning about a 16.5% return on capital, so that's just a few percentage points above that 14% benchmark we're looking for, and that's solidly above the returns from an average business, so this is a check to start things off on metric number 1 here for Oracle. Next up for metric number 2, here we're taking a look at the high-level overview of the growth of the business. So we're looking for revenue, net income, and free cash flow growth over the last 5 years. And this metric is all or nothing in nature. Either all 3 of these are going to be up for this to be a check, or if even one of these is down, this entire metric will be an X. At the same time, we'll be including their last 12 months worth of numbers in our calculations here. So over this period, Oracle's revenues have increased by 17%. So modest revenue growth for Oracle. Their earnings have more than doubled after being depressed in fiscal 2018. However, at the same time that their earnings are up, their free cash flows are down nearly 40% from where they were at in 2018 until currently, meaning that because their free cash flows are down, this is an X on metric number 2. Of all of these numbers being down, it's disappointing to see that their free cash flows were lower because free cash flow is really the lifeblood of any business. And a business can use its free cash flows to pay dividends, reinvest back into the business, make acquisitions, buy back shares, or pay down their debt. And ultimately, a business's abilities to produce free cash flows now and until Judgment Day, discounted back by some reasonable interest rate, is what that business is going to be worth. So again, disappointing to see that their free cash flows are down so dramatically here. This is our first X of the day coming in on metric number 2. Next up, for metric number 3, here we're taking the perspective of an individual shareholder in the business by looking at Oracle on a per-share basis. So we're looking for earnings per share growth over the last 5 years. Again, Oracle had a depressed 2018 due to higher than average income tax expenses in that year. At the same time that that's happened, Oracle has repurchased around 35% of their shares outstanding. So this is likely great for long-term shareholders in the business because when you purchase a share of stock, what you're really buying is a fractional ownership percentage in that underlying business. So when a business buys back shares by decreasing the amount of stock that they have outstanding, they're increasing your ownership percentage in the business, which is ultimately going to increase your percentage of the business's profits going forward without you having to spend a dime. So it's almost as if the company is making a partial acquisition of itself. And so just like with any other acquisition, we want businesses buying back shares when they're getting more value for existing shareholders than the price that they're paying. So in realistic terms, what this means is that we want businesses that are buying back shares when the company is trading for below its intrinsic value, and those buybacks look like an attractive use of their capital relative to some of their other opportunities. So Oracle's management clearly thought that this was the case over these last 5 years. Again, they've repurchased 35% of their shares outstanding, so they bought back more than a third of the business over this period. That outpaces their earnings decline over this time. This is a check on metric number 3, as they've seen earnings per share growth because of these buybacks. Then metric number 4, we're looking for something similar. So here we're looking for free cash flow per share growth over the last 5 years. So again, we learned that their free cash flows are down by nearly 40%. And at the same time, Oracle has bought back 35% of their shares outstanding. So Oracle has earned about $3.13 worth of free cash flow over their last 12 months. And so while that's much better than what they did in fiscal 2022, that is slightly down from where they were at in 2018. And so this is an X on metric number 4 here. So far through our first 4 metrics, we're split evenly, 2 checks and 2 X's for Oracle. Then next up for metric number 5, here we're evaluating how the business is utilizing debt. So we don't want to be investing in overly levered businesses because during economic downturns, it's overly levered businesses that are going to be at the greatest risk of poor outcomes. So we want their net debt, which is their total debt minus their cash and their short-term investments, to be below the amount of free cash flow that Oracle has produced over the last 5 years. Oracle has added quite a bit of debt onto their business over this period. They had about $6.5 billion worth of cash left over after paying off all of their debt in 2018. They ended their fiscal 2022 with about $57.5 billion worth of net debt. Since then, they've even tacked on more. Right now, Oracle has about $83.5 billion worth of net debt, which is a very large amount of net debt. And over their last 5 years, the company has only produced around $47 billion of free cash flow. So that looks like right now the company is utilizing much more leverage in their business than their free cash flows are able to support. This could be a potential concern for possible investors into the business. So this is something that you would likely want to dig in and do deeper research into to understand this debt profile in more detail. Potentially especially concerning is that these higher debt loads have come as the business's free cash flows have fallen pretty dramatically. And over their last 12 months, Oracle has only produced about $8.4 billion worth of free cash flow. So that's down from where they've been at historically over this period. And their free cash flows were similarly down in 2022 as well. So again, this is an X on metric number 5, and so far through our first 5 metrics, we have 2 checks and 3 X's for Oracle. Then next up for metric number 6, the big metric of them all, we want their average free cash flow to their total enterprise value to give us a yield that's above 5%. If this is the case, this will give us a slight risk premium to the yield of the 10-year treasury and potentially give us another reason to be interested in Oracle. So we're using their total enterprise value because it's taking into account both their market cap and their net debt position, and it's going to give us a picture of the economic reality of the business that's more similar to as if Oracle were a private company. So right now, Oracle has a $301 billion total enterprise value, and we learned that in the last 5 years, they've produced $47 billion worth of free cash flow, meaning that in an average year, Oracle is producing about $9.4 billion worth of free cash flow. So when we divide their $9.4 billion of their average free cash flow by their $301 billion total enterprise value, that gives us about a 3.1% average free cash flow to enterprise value yield for the business. So that's both below that 5% benchmark we're ideally looking for, and that's slightly below the yield of the 10-year treasury as well. So this is an X here on metric number 6. Again, as we learned in our previous metric, their free cash flows are down over their last 12 months. So it's worth being aware that their current free cash flow yield is even down from where they've been at historically. So again, over their last 12 months, they've earned $8.4 billion worth of free cash flow. So to get a current free cash flow to enterprise value yield for the business, when we divide their $8.4 billion of their last 12 months of free cash flow by their $301 billion total enterprise value, that only gives us a 2.8% current free cash flow to enterprise value yield for the business. Just because this is an X here doesn't mean that you're going to throw out this business in its entirety. This is just one of our 6 metrics. This analysis is meant to be taken in holistically, and it's not financial advice. So even though these metrics are simple, when combined together, they can be very powerful. So as a bonus, here we're looking at Oracle's dividend profile. So again, Oracle is currently paying out about a 1.6% dividend yield, which is about right in line with that of the yield of an S&P 500 ETF. Oracle has grown their dividend payouts in all 5 of these recent fiscal years, and at the same time, they've had plenty of free cash flow, well more than enough to comfortably support this in 4 of these 5 years. They've been able to support their dividends in all 5 years. However, with their recent free cash flows coming down from where they've been at historically, and the large amount of increased debt that the business has brought on, it does look like there's some stress around their potential to keep growing their dividends into the future. Unless Oracle is able to increase their cash flows, it does look like the business would have some difficulties potentially growing their dividend going forward. So if Oracle's ability to pay out dividends is part of your initial interest in the company, this would just be something that you would want to dig in and understand in more depth and truly be able to understand where the company's free cash flows are likely to be in 5 or 10 years from now. Then everything we've discussed so far is important, but there's something missing that in my opinion is the main reason to analyze Oracle, which takes us on to using a discounted cash flow model to come to a potential fair value for the business. So a discounted cash flow model is just like any other model in any other discipline. Its outputs are going to be sensitive to its inputs. So starting with an average of their free cash flows over their last 3 years. So again, this is down very significantly from what Oracle's free cash flows have been like in the past. Their free cash flows are pretty depressed over this time frame. Then using historical growth assumptions for how the business has been able to grow their free cash flows dating back over the last 20 years. So these are historical growth assumptions that you need to do your own homework on to determine whether or not these are going to be potentially accurate or applicable going forward for Oracle. So assuming a growth stage over the next 10 years where they grow their average free cash flows at a rate of about 8% annually, and then using a terminal stage for the 10 years after that where this growth rate falls to only 5%. If we add in their tangible book value today and we were ideally seeking a 10% rate of return going forward for Oracle, then it looks like a fair value for the business is only around $21 per share. That's significantly below what their current stock price is at. Using these same historical growth assumptions from today's valuations, it looks like you could only reasonably expect about a 2% rate of return going forward for Oracle. There are a couple of caveats to mention here. We would not be doubly counting their dividends in either of these discount rates, so their 1.6% dividend yield would make up the majority of this 2% rate of return. There are a number of reasons why this might not be potentially accurate or applicable going forward for the business. That's why it's really worth digging in and learning more about the company if you're interested. Please be mindful that this type of analysis is not financial advice. It's not a buy or sell recommendation of any security. And before considering any potential investment decision, please consult with your properly licensed and registered legal and financial professionals. So in just a minute, we'll talk about our recap for Oracle, but we have to address something first. What are some of the qualitative aspects of this business, especially those for the key points around a potential long or a potential short thesis of the company? Starting with some of the key points around a potential long thesis for the business. Number 1, Oracle's stake in TikTok Global and cloud operations to TikTok's US operations should add a significant boost to Oracle's top line and attract more general use cloud customers. Number 2, Oracle's autonomous database and infrastructure as a service was built with ease of use in mind, which could bring a significant base of first-time Oracle users to the company, potentially strengthening top-line results. And number 3, Oracle's relational database should be able to post strong growth as customers continue to depend on its quality features, such as data partitioning, which brings incomparable load balancing efficiency. Then for some of the key points around a potential short thesis for the business. Number 1, COVID-19 could accelerate Oracle's customers' digital transformation efforts, thus causing Oracle to lose customers at a faster pace than expected. Number 2, Oracle's cloud business could struggle to win business as alternative software as a service and database systems leave little incentive to select Oracle infrastructure as a service. And number 3, Oracle could suffer below average growth as customers are prompted to change databases and software providers in their transition to the cloud. Hopefully that offers a potential balanced perspective around some of the key points for a potential long or potential short thesis of the business. Now it's time for our wrap up. So in summary, Oracle checks the box on 2 out of 6 of our metrics. They're earning average returns on capital in the mid-teens, so they're above that 14% we're looking for. Their revenues have grown over this period. However, their earnings and their free cash flows are down, so their gross and their operating margins are down over this time. The company has bought back 35% of their shares outstanding over this time, so they've repurchased more than a third of the business, which could potentially be good for long-term shareholders in the company if the business is able to get back on track to where they have been with their free cash flows. So over the last 5 years, Oracle has tacked on quite a bit of debt to their business, and right now it looks like they're utilizing more debt than what both their historical and their current free cash flows can support. So their high debt loads are a potential concern for the business that you would want to dig in and learn more about if you're interested in the company. Then on both an average and a current basis, comparing their free cash flow to their enterprise value, That yield was not giving us the adequate risk premium we're ideally seeking in comparison to the yield of the 10-year Treasury. Looking at their dividend profile, while Oracle has grown their dividends over the last 5 years, and they've had enough free cash flow to be able to support these in all 5 of these years, with their recent declines in their free cash flows, unless those are able to pick back up, it does look like Oracle would have potential trouble increasing their dividends going forward into the future. They would likely have to balance some of these dividend payouts with their other uses of capital, such as their buybacks and servicing this high debt load. Then finally, performing a discounted cash flow analysis of Oracle using their average free cash flows and based off these historical assumptions for their growth into the future. If you've done the work and you believe these assumptions, then from today's valuations, it looks like you could reasonably expect only about a 2% rate of return going forward for Oracle, with about 1.6% of this being eaten up by their dividend yield. So there are a number of reasons, again, why that might not be accurate for the company. So it's worth reiterating that this type of analysis is not financial advice, it's not a buy or sell recommendation of any security, and before considering any potential investment decision, please consult with your financial advisor. This analysis instead serves as a beginning and holistic understanding of Oracle to help you determine whether it's worth your time and energy to dig in and learn more about the business. One resource that will definitely help you stay up to speed with what's going on in the market and help you learn more about the business is Seeking Alpha. Checking out Seeking Alpha directly supports the channel as I'm part of their affiliate program. So most of you probably know Seeking Alpha as a source of community-written articles on different stocks. But over the past little while, they've actually become a lot more than that with their new offering, which is Seeking Alpha Premium. Premium has a number of different features where you can track buy, hold, and sell ratings on your favorite stocks. These ratings are from the Seeking Alpha community, Wall Street analysts, and Seeking Alpha's algorithm. You can see earnings call transcripts, investor presentations, SEC filings, and press releases all in one place. You can add your own margin of safety targets and get alerts for when your favorite stocks hit that level. You can get unlimited access to Seeking Alpha articles, and you can tailor your reading experience based on the type of investor you are. You can get 10 years of financial data on any stock to help you with your analysis. You can also import your portfolio into your Seeking Alpha dashboard to make researching easier. And if that didn't convince you, the best thing is that an annual plan is only $99. That's only 27 cents per day through my referral link down in the description below. Normally, premium is $239, but they are currently running a general offer for $119. But if you use my link, it's only $99. So check it out if you're interested. So as a value investor, you ultimately want to conduct this research as if you're going to own 100% of a business, and you can truly understand its ins and outs and understand what's important and what's not important for the company going forward to really get at the underlying essence of the company. Through this deeper research, you'll learn more about the qualitative and the quantitative factors of Oracle's business, and you'll likely be able to determine for yourself what a reasonably appropriate intrinsic value for the company will be. So with that said, that's it for today's fundamental stock analysis of Oracle Corporation, ticker symbol ORCL. Again, we looked at the business as a subscriber request today, so I'm happy to make an analysis of the company. And if you enjoyed today's video, please be sure to like the video, subscribe to the channel for more stock analysis videos, and comment down below what business you want me to take a look at next time. Thanks for learning about Oracle with me, and have a great day.